Welcome back to the deep dive. There's this specific feeling, I think we've probably all had it, where driving your car, cruising down the highway, and the dashboard says everything is totally fine.
Oh yeah, the speedometer is steady.
Right. The gas gauge is full, no check engine lights are blinking at you, but you can hear something,
A rattle.
a rattle, or maybe a weird thud near the back tire, and you just know something is wrong, even if the dials are telling you you're good.
That is honestly the perfect metaphor for where we are right now. It's that intuitive sense that the machinery just isn't running as smoothly as the manual says it should be.
Exactly. So today we are popping the hood on the U.S. economy because as of right now, February 2026, if you just look at the headlines, it looks like a party. Stocks are hovering near highs. Job numbers look really robust on paper. But we have a stack of source material here, data revisions, analyst reports, deep dive articles that strongly suggest the engine is actually sputtering.
And honestly, sputtering might even be generous. The analysis we are unpacking today argues that we are witnessing a classic Wile E. Coyote moment.
Wait, the cartoon? I haven't thought about Looney Tunes in years.
Yeah, exactly, the cartoon. You know the scene. The coyote is chasing the roadrunner. He runs straight off the edge of the cliff, and his legs are still spinning. He's just hovering in midair.
He's totally fine.
He is absolutely fine, right up until the exact moment he looks down.
And then gravity kicks in.
Precisely. The central thesis of the sources we're looking at today is that recessions don't announce themselves with the trumpet blast. They are retroactive.
Right.
By the time the authorities officially confirm we're in a recession, you've usually been falling for 6 months.
Yeah.
The argument here is that the U.S. economy has already run off the cliff. We just haven't looked down yet.
That is a seriously heavy claim. So our mission today is to force ourselves to look down. We're going to walk you through 3 specific cracks in the foundation that the headline numbers are currently hiding.
Right, the stuff beneath the surface.
Exactly. A job market that isn't what it seems, a consumer debt bomb that's ticking much louder than people realize, and the total disappearance of our savings cushion.
And we absolutely have to talk about the wild card.
Oh, yes.
The one entity that might catch us before we hit the canyon floor or accidentally make the crash way worse, the Federal Reserve.
Right, the Fed. So let's start with that first crack, which is the job market. Because honestly, when I opened the source material for this deep dive, I was a bit confused. I saw the headlines for the January 2026 jobs report, and they were spectacular.
On the surface, absolutely phenomenal was the word a lot of analysts were throwing around. I mean, the economy added 130,000 jobs in January alone.
Which was basically double what the experts predicted.
It completely smashed expectations.
Mm.
Unemployment dropped to 4.3%. If you are a politician or a day trader, you look at that and say, the American economic engine is roaring. We are back in business.
So why does the research we have call this a mirage? I mean, 130,000 jobs is 130,000 jobs. You can't fake a paycheck.
Well, you can't fake it, no, but you can misinterpret where it's actually coming from. When you peel back the layers of that January report, the overall quality of the growth is highly suspect.
How so?
The majority of those gains weren't in what we'd call the productive private sector, so not tech, not manufacturing, not business services.
Where were they then?
They were heavily concentrated in healthcare and social assistance.
Okay, but just playing devil's advocate here for a second. A job in healthcare is still a job, right?
Mm-hmm.
Why is that considered a red flag?
It's about sustainability, really, and organic economic demand. Healthcare and social assistance are sectors that rely incredibly heavily on government funding and purely demographic trends, like an aging population.
Oh, I see.
Yeah, they aren't necessarily indicators of a thriving, dynamic consumer economy where businesses are actively expanding because people are buying more widgets or utilizing more commercial services. It's a somewhat subsidized type of growth.
Right.
And that masks the fact that the cyclical parts of the economy, the parts that actually signal a healthy, growing business environment, are stalling out.
So it's kind of like counting calories to see if you're getting enough energy, but realizing half of your calories came from celery. I mean, it fills the plate, it takes up space, but it doesn't give the economy the same kind of kinetic energy.
That's actually a really decent way to put it.
Mm.
But if you think that sector breakdown is worrying, just wait until we talk about the data revisions.
Yes, this part.
This is the part of the deep dive where the jaw really hits the floor.
This was the absolute shocker for me. We're talking about the data for last year, for 2025.
Correct. This is the aha moment that explains the Wile E. Coyote theory perfectly. The Labor Department released their benchmark revisions for the entire year of 2025. Now, Now, all through 2025, we were basically told the economy was adding jobs at a very healthy clip.
Right.
The original estimate they put out was about 584,000 jobs added for the year.
Which is pretty solid. It's not an insane boom, but it's stable. Nearly 600,000 people getting work. That feels like a safe, functioning economy.
Exactly. But the revised data, they absolutely slashed that number. The actual number of jobs added in 2025 was, get this, 181,000.
Whoa. Just hang on. Let me just do the math on that for a second. They thought it was nearly 600,000, and it was actually under 200,000.
They missed by over 400,000 jobs. That is just a massive discrepancy.
That's not a margin of error. That's a hallucination.
Right. And it changes the entire narrative of the last 12 months. We all thought we were growing moderately. In reality, we were barely treading water. To really put it in perspective, compare 2025 to 2024. In 2024, the economy added nearly 1.46 million jobs.
Okay, so 1.5 million in 24, and then less than 200,000 in 25.
Exactly. That is a screeching halt. That is a car slamming on the brakes. But because of the way data is reported and then, quietly revised months and months later, nobody felt the whiplash until right now.
We were cruising along thinking we had momentum, but the engine had actually already cut out.
Precisely. We ran off the cliff months ago.
This is exactly why the sources are saying we might already be in deep trouble. Because if job growth effectively flatlined last year, that means income generation flatlined.
And the U.S. economy is 70% consumer spending. You literally cannot have a growing economy if people aren't earning new money. If the jobs machine is broken, the spending machine is going to break next.
Which is the perfect segue to our second crack in the foundation. Because if people aren't earning more money, I look around and I still see people buying things. I see full restaurants. I see delivery trucks in my neighborhood every day. If income is stalling, how on earth is the spending continuing?
It's the four-letter word that kills economies: debt.
Yeah.
This brings us to the second warning light flashing red on our dashboard. The consumer wallet is basically being propped up entirely by plastic.
I saw the top line number in the notes, and it's staggering, $18.8 trillion.
Yes. As of the fourth quarter of 2025, aggregate household debt hit $18.8 trillion.
It's such a big number, it almost loses meaning. It sounds like a made-up number from a sci-fi movie. Is that just mostly mortgages?
Most of it is housing, yes. But the dangerous part, the part that actively fluctuates with economic stress, is the non-housing debt. Credit cards, auto loans, student loans, that slice of the pie is now nearly $5.2 trillion.
But isn't debt just a tool? Just to push back a little, if I make $1 million a year, having a $50,000 credit card bill isn't a crisis. It's just cash flow.
You're right. Debt is completely relative to income. If incomes were rising fast like they were during the 2024 boom, this level of debt would actually be manageable. But remember our first point. Income generation has hit a brick wall.
Ah, right.
So you have rapidly rising debt meeting stalling income. And the proof that this is becoming a genuine crisis is in the delinquency rate.
The people who are stopping their payments, the people who are, ghosting the bank.
Exactly. Aggregate delinquencies have ticked up to 4.8%. That is the highest level we have seen since 2017.
So we are seeing more people falling behind on their everyday bills right now than at any point in almost a decade.
Correct. And you also have to factor in student loans here. Remember, for a few years during the pandemic, there was a pause. That was breathing room. That was essentially extra cash in people's pockets every month.
Right. They could spend that on retail or dining.
But now that payments have fully resumed, that is another $300, $400, maybe $500 a month leaving people's checking accounts. It's the straw that is breaking the camel's back for a lot of households.
But here's where I get confused, and I think a lot of our listeners might feel this tension too. You have this hard data saying people are broke and defaulting. But then you have someone like Brian Moynihan, the CEO of Bank of America, a guy who literally sees more bank accounts than anyone else on the planet, saying that spending is actually accelerating among their customer base.
Right.
And you have retail sales actually growing in January. So who is lying here?
The crazy thing is, neither of them is lying. They're just looking at entirely different parts of the letter K.
The K-shaped economy.
Exactly. Visualize a capital K. The vertical line is the overall economy. Then you have those two arms. The top arm points up. That represents the asset owners, the high-income household.
To people who own stocks, who own real estate.
Right. For them, the last few years have been absolutely fantastic. The stock market is up. Home values are historically high. They feel wealthy. This is what economists call the wealth effect.
When your portfolio looks good, you feel super comfortable buying the $8 latte or booking that summer trip to Europe.
Exactly. That is who Brian Moynihan is largely seeing in his premium data, the people with assets.
But the bottom arm of the K.
That points straight down. That's the lower income and increasingly the middle income households.
Yeah.
They don't own a stock portfolio. They might rent or maybe they bought a home recently at those really high interest rates. They don't benefit when the market booms. They only feel the pain of inflation at the grocery store and the fear of the job market slowing down.
The source material actually mentions something really interesting about mortgages, specifically in this context.
Yes, it described a split-screen reality. Overall mortgage delinquency across the country actually looks pretty normal. But if you zoom in closely on lower income areas, or specifically on regions where home prices have just started to dip, delinquencies in those pockets are deteriorating rapidly.
So the broad averages are masking the localized pain. The top 20% is party the bottom 50% is drowning, and if you just average them out, the math makes it look like everyone is just comfortably treading water.
Exactly right.
Okay.
But you cannot sustain a broad consumption economy on just the top 20%. Eventually, the foundation cracks, and that drags the whole structure down. The people at the bottom arm of the K are essentially the canary in the coal mine.
And that leads us perfectly to the third crack we need to discuss, the safety net. Because back in 2020 and 2021, even if you lost your job or things got tight, you had a buffer. We all basically saved money during the lockdowns.
The pandemic buffer. It completely distorted our sense of economic reality for a few years. Think back, interest rates were effectively zero, the government was literally mailing out checks, and you physically couldn't spend money on normal things like vacations or concerts.
The personal savings rate skyrocketed.
It did.
People were super flush. I remember so many stories of people suddenly paying down old debt, buying crypto, doing massive home renovations.
We all felt it. But the source material for this deep dive makes it abundantly clear that party is officially over. The buffer is totally gone.
What do the specific numbers say on that?
As of November 2025, the U.S. personal savings rate dropped all the way down to 3.5%.
Just to contextualize that for me, is 3.5% notably low?
It is perilously thin. For context, in January 2024, which is just 2 years ago, it was 6.5%. So we have cut our collective savings rate nearly in half in just 24 months.
Wow.
Historically, a healthy, stable savings rate is somewhere in that 5 to 7% range. When you get down to 3.5%, it means people are spending almost every single dollar they earn just to stay afloat.
They aren't saving for a rainy day anymore because it's basically raining right now.
Exactly. And this completes the really dangerous feedback loop we've been building. Let's just connect the three dots we've talked about. One, the job market is actually barely moving, exposed by those massive downward revisions. Two, consumers are racking up record levels of debt just to maintain their current lifestyle. And three, they have completely burned through their savings buffer to pay for it all.
So if this thing breaks, if they actually lose that job, or even if their hours just get cut, there is zero cushion left.
They default almost immediately. And we know how that plays out. When consumers default, the banks tighten their lending standards. When banks tighten lending, businesses can't get credit to expand. When businesses can't expand, they lay off workers. And there is your recession.
It really feels like we are watching a slow-motion car crash. It explains so well why the vibes just feel off out there, even if the stock market is still up. But, and there is always a but, in economics, the source material brings up a wild card, a potential savior.
The Federal Reserve.
The Fed, the lender of last resort. The classic argument is that whenever the economy starts to wobble like this, the Fed swoops in, cuts interest rates, prints money, and completely saves the day.
Right. The Fed put.
Can we explain that term for a second? The put.
Yeah, it comes from options trading. A put option is basically an insurance policy that protects you if a stock goes down and creates a loss. In this broader context, investors have come to believe the Federal Reserve literally is the market's insurance policy. If the stock market drops 20%, the assumption is the Fed will immediately step in to fix it.
But the cast of characters over at the Fed is changing right now. We have a new chair coming in, Kevin Warsh.
And this makes the whole dynamic fascinating. Kevin Warsh has historically been a very vocal critic of the Fed put. He has argued for years that the Fed intervenes way too much, that it bails out Wall Street too often, and that it should really just let the market take its medicine.
So he's sort of the tough love parent. He wants to let the kid scrape his knee so he actually learns not to run with scissors?
In theory, yes. He strongly believes in free markets operating freely. But the source material makes a crucial counterpoint. It is incredibly difficult to actually be the tough love parent in 2026.
Why is that? Why can't he just come in and say, no more bailouts?
Because of the massive financialization of the economy. It's not just billionaires and hedge funds who get hurt by a market crash anymore. It's Main Street. Far more retail investors, just regular, everyday people, have their retirements, their savings, their entire sense of security completely tied to the stock market than ever before.
Oh, I see. So if Warsh decides to let the market crash just to teach Wall Street a lesson, he's simultaneously wiping out the 401ks of the voters.
Yes, exactly. A 20% drawdown in the S&P 500 isn't just a red number on a Bloomberg terminal anymore. It's an immediate political crisis. It affects consumer confidence the very next day. And the source explicitly mentions the heavy political pressure here. President Trump has been very vocal about wanting lower interest rates.
So even if Warsh wants to be tough, the pressure from all sides to deploy the airbag might just be overwhelming.
The broad expectation is that he will fold. The Fed put is still alive and well. The market's argument goes exactly like this. We know the labor market is actually weakening, thanks to those massive revisions we talked about, and we know inflation has mostly come back down toward the Fed's 2% target.
And that gives them slack, right? That's the term the analysts always use.
Yes, slack. Because inflation is relatively low, the Fed has permission to cut rates. They can stand up and say, look, we beat inflation, now we need to pivot and help the workers. They can cut rates, make borrowing cheap again, and effectively prop up the stock market.
It's the perfect escape hatch. The economy slows down, the Fed cuts rates, stocks go up, everyone feels wealthy again, and we steer the car away from the cliff.
That is the ultimate bullish case. That is exactly why the stock market is still near all-time highs, despite all this bad underlying data.
Yeah.
The market is confidently betting that the Fed will save us.
Yeah, you pause there. You have that look on your face.
I did, because that whole safety net has one fatal flaw, a very specific condition that absolutely has to be met.
Which is?
Inflation must stay dead.
Ah.
The entire Fed Save strategy relies 100% on inflation being low. If inflation is at 2%, they can easily cut rates to save jobs. But what if inflation spikes back up to 4 or 5%?
Then they can't cut rates. In fact, they might actually have to raise them to kill the inflation.
Exactly. If we have some unforeseen event, a sudden supply chain shock, a new geopolitical crisis, a conflict that spikes global oil prices and inflation flares up at the exact same moment the underlying economy is slowing down, the Fed is completely handcuffed.
They would have to choose. Do we fight the inflation or do we save the economy from recession?
And historically, their legal mandate forces them to fight the inflation first. They cannot do both at the same time.
That's the nightmare scenario, isn't it? Stagflation. High inflation and a recession happening simultaneously, and suddenly there's no airbag.
That is the massive risk that almost nobody is pricing in right now. We are driving a car with really shaky brakes, the tapped-out consumer, the engine is sputtering that revised job market, and we're just casually counting on the airbag, the Fed, to save us if we crash. But we are completely forgetting that if the weather changes and inflation spikes, the airbag literally doesn't deploy.
Wow. It really changes how you look at the green arrows on the TV screen every morning. It feels way less like a reliable scorecard and much more like a gamble.
It does. It forces you to pause and ask, is this real structural growth, or is it just the momentary momentum right before the drop?
So to bring this all back to a central, actionable point for you listening, the main takeaway from all these sources isn't necessarily to panic and go sell everything in your portfolio. It's about being eyes wide open.
Absolutely. It's about understanding the nuance beneath the headlines. When you see a headline that says 130,000 jobs added, don't just blindly cheer. Ask, what kind of jobs are they, and what happened to the revised numbers from last year? When you see consumers actively spending at the mall, don't assume they are rich. Ask, are they just putting all of that on a credit card at 24% interest?
And when you hear that the Fed is definitely going to save the market, ask, what happens if inflation comes back?
True financial knowledge is just connecting those dots. The stock market is not the economy. And very often, the headline numbers we get are just a rough draft, a draft that, as we plainly saw with the 2025 data, often gets completely rewritten months later when no one is watching.
That is a very sobering thought to end our analysis on. We're essentially living our day-to-day lives in the rough draft of history.
We always are.
Well, here is the final provocation I want to leave you with today. We've talked a lot about the hard mechanics during this deep dive, rates, debt levels, job revisions. But I want you to think about the psychology of it all. The entire financial system right now seems to be built purely on faith. Faith that the Fed always has control, faith that the consumer is endlessly resilient. If that faith cracks not the actual data, but just the collective belief, how fast does the reality change? If the Wile E. Coyote moment isn't actually about the physics of gravity, but just about the sudden realization that there is no solid ground beneath you, how long can we really keep running on air?
That's the trillion-dollar question right there.
Thanks for diving deep with us today. Keep questioning the data, keep looking under the hood, and we'll catch you on the next one.